Intangible drilling costs, striking gold with an 80% tax write-off. Welcome to this episode of the Hidden Money Podcast. We are going to go over oil and gas investments, specifically the amazing tax gold nuggets that are there with them. You can write off a heck of a lot of what you invested and make long-term money. Don't ever let your tax tail wag your business dog. Make sure it's the right oil and gas investment. But boy, IDCs, intangible drilling costs, Kevin, they are a beautiful thing.
They are, and it's a very specific section of the tax code that allows for this. And we've gone over oil and gas in the past. We just want to refresh it and bring some more to the table for you guys. So when we're talking oil and gas investing, the IRC, the Internal Revenue Code, is chock full of incentives. That's all it is. That's how Mike and I view the IRC. That's how we view everything through that lens, is taxes are an incentive to invest and to spend money wisely to reduce our burden and reinvest those tax savings into other future assets. That's what we try to do. And with oil and gas, there's ways to invest into oil and gas to reduce your W-2, to reduce your self-employed business income, any classification of income. If you have interest, dividends, cap gains, real estate income, I don't care where your income's coming from. If you have income, oil and gas can help eliminate that tax burden by investing into it through the power of intangible drilling costs.
This isn't snake oil sales, but this is a plug for oil and gas because it is a beautiful, beautiful thing. Kevin and I have had so many different episodes, and we'll have so many more on all the amazing things you can do to lower your tax bill so that you are building your financial freedom. Like Kevin said, the Internal Revenue Code is a beautiful tool that you should leverage in growing your financial freedom. That's why we have Hidden Money. But we're going to talk about this oil and gas. Like he said, the IRS requires us to track income in 3 separate buckets, right? Active bucket, passive bucket, and portfolio bucket. Generally, you can't offset. Everyone knows this rule. You can't offset your W-2 income. If you have a $100,000 capital loss because you made a bad play in the stock market, that hurts. And it really hurts when you find out at tax time you can only reduce your W-2 by $3,000 a year for the next 33 years. I mean, that hurts. So how do you get tax losses to offset all of your income, all of your buckets of income? There's a lot of ways, but very few of those ways are truly 100% passive. And that's another reason I like about it. Very few of those ways can you choose to implement December 15th and still get the tax deduction for that year. What I like about it, again, is if you're buying a good oil and gas investment, it's going up in value. It's appreciating. It's providing you cash flow, potentially generational wealth. And the IRS subsidizes it through that incentive.
That's right. And going back to the buckets, if you have an active tax problem, passive losses, portfolio losses, like you said, aren't going to help you. So just to show, just do this yourself. Go to Google right now. Type in Internal Revenue Code or type in IRC 469. 469 is the section that governs passive activity losses. Put a C and put a 3. Section 469C3 is going to give you the most powerful sentence when coming to oil and gas investing. And you can see for yourself in the own internal regs. Just look at it. 469C3 says that if you invest into a working interest operating oil and gas operation as a general partner, those are not treated as passive for tax purposes. Passive. What is passive? If you invest into a business that you don't manage.
Angel investing.
Angel investing. If you invest into real estate and you're not a real estate professional or manage the property, that's passive. It's what the term says. You are passive. If you're passive in any other area of your life, you're not doing anything, right?
Yep.
Same in tax. If you're not doing anything and creating loss, they're not going to allow your passive losses to offset your active income unless you're investing into working interest, to which at that point, they're going to allow passive losses to offset active income. You're not working the fields. You're not pumping the oil. You're not doing any geological studies, nothing. You're not managing anything. You may have zero expertise in oil and gas, but it's going to allow for active losses. So this is where the power comes in. And the magic behind these losses is intangible drilling costs, IDCs. So What would you define intangible drilling costs as?
So when you drill an oil well, a whole bunch goes involved, but the biggest expense, generally at least 75 upwards of 85% of the cost of drilling that well, is your labor and all the things that go into it. Your renting of the drilling rig, if you don't own yours, all of that stuff is considered intangible. Most areas in tax, we don't like intangible for deductions. Intangible means, you have to amortize. You can't deduct.
You can't deduct it.
This incentive is put into the tax code to help our nation be energy self-dependent. So we don't have to rely on the Middle East or Russia to have the energy that we need. And why it's there is so that people will put money into oil and gas and invest in it. So you invest, you spend $1 million drilling a well, let's say 85% of that's your IDCs, your intangible drilling costs. Everyone involved in that business gets to deduct 85% of what they put in under the right structure. You got to be careful with this. Let's talk about some of the requirements for it, Kevin.
Yeah. So some of the requirements for intangible drilling costs, well, there's one big thing that I want to make sure we need to talk about AMT. And just let me real quick before we get into the specifics, just numbers real quick. If you make $100,000 as a W-2 earner, and you have the cash flow to invest $100,000 into an oil and gas operation, a working interest, you are going to reduce your W-2 by maybe $70,000 to $80,000. Now you need the capital, but this is why if you're making $100,000, you may not be able to invest in this. You have to be accredited first to invest into oil and gas operations.
Not always, but generally speaking.
Generally speaking, you have to be accredited, which is making $200,000 a year. If you're married over the course of a couple of years and have a net worth of over $1 million, not including your primary residence, if you're accredited, you can get into these types of deals generally. So these might be geared more towards people making $400,000, $500,000 a year, just because you're going to have the disposable income. You're going to be accredited to invest in these things. So typically for every dollar you invest into an oil and gas operation, you're getting a deduction of 70% or 80 cents on that dollar.
Sometimes more.
Yeah.
This year in 2025, with the return of 100% bonus depreciation, you're not just going to get your 70 to 80 or higher percent of IDCs. You're going to be able to depreciate all the equipment they put on there, the wellhead, the piping, the injector wells. So you might even see a 90+% deduction this year, as long as all of that equipment is placed in service before the end of the year. We know some funds out there that are raising now, expecting 100% bonus to come back. They need to raise now and start their operations, because to get the bonus depreciation component this year, it has to be operating and placed in service by the end of this year. Let me back up for a second though. This, as Kevin has mentioned, this only applies to be able to take this deduction against your active income. It only applies if you're invested in a working interest. What is a working interest? There's two kinds of interests or ways to invest in oil and gas, or ways of receiving income in the future from oil and gas. You can invest in a working interest, means you either own or you own a piece of the actual operation that is drilling and operating that rig to produce the petroleum out of the ground. That is a working interest. Whereas some of you might know, you have a cousin or a friend or someone through some third degree of separation, or whatever, you know someone, they were a rancher out in North Dakota. Someone found oil on their land and they went and leased that land and gave them a royalty interest. They're getting 15% or 10% of every dollar that's generated out of that well. That is a royalty interest or a mineral interest. You can't get this IDC deduction in one of those. So it has to be a working interest, but you can't own it in any way, shape, or form you want. There are limitations.
Limitation number one, well, the biggest limitation is you can't scrub away your personal liability. That's one piece. There has to be at risk. Hence and when you go to that 469C3 subsection of the IRC, I told you, go do your homework. When you go there, you're going to see it has to be a general partner. General partner, what is that? A general partner means you don't have any limited liability. Now, we're not attorneys. I can't give you legal advice, but generally speaking, what happens is if you invest as a general partner, you are personally liable for the liabilities of that operation. Meaning, if there's a wrongful death suit, if the business goes under and they get sued, or whatever possibility under the moon could happen, they could personally name you personally in the lawsuit, so your personal assets could be at risk. So it has to be something at risk. If you invest, if you create, you're like, forget that. I'm going to create an LLC holding company. Then I'm going to invest with my LLC into the oil and gas, and then that way I'm going to partition.
You don't get the deduction.
Don't get the deduction. All well and good. You could do that technically, and there's nothing stopping you from doing that. I mean, if liability is a big protector for you, but we even have a solution for that.
Yeah.
But if liability is a big thing for you, you're not going to get this IDC deductible in 1 year. It's going to be passive. It's not going to be deducting against your W-2. So you can't have your cake and eat it too. You have to have risk and liability to get the big tax break in year one. If liability is more of a concern for you, invest through an LLC, and then all those losses attributed to you are just going to be passive in nature, not giving you the tax bump.
Which gives me reason to remember, last year I had a client send me a prospectus. He was thinking about 2 years ago going in an oil and gas well. And I said, well, let me look at the PPM, the private placement memorandum, and see it. He sends it to me on the front of the PPM. And these guys, this oil and gas syndicator was promising him the IDC deduction. It was so-and-so Oil and Gas LLC. Doesn't work.
Yeah.
What you need to see is either a general partnership, more likely it's a limited partnership. And let's talk about that for a second before we get into some more of these details on structuring. Most legitimate and experienced oil and gas syndicators and operators out there, they bring you into their limited partnership as a general partner. And then once you've harvested those IDCs, we don't want that GP liability, right? That's the scary part of oil and gas. That and a lot of oil and gas investments don't pay out. But you have that general partner liability as long as you're GP. Once you've harvested that IDC, they switch you over, and it's written in the agreement that you sign, to a limited partner. So you only have the general partner liability for the time frame that you were a GP in it, and then once it's an LP, you're good. But again, we're not attorneys. 5 years down the road, someone could find out that, hey, there was a wrongful death and it was covered up and you're liable for it, even though you're a limited partner now. If it happened when you were a GP, boom, that's an issue. What else in structuring do we need to cover?
So I'll provide maybe at the end of this podcast. Stay tuned. Keep watching this through, because I'm going to provide some relief for you on the general partner liability. We got solutions for you to where you can get the deduction and make sure you're not getting all of the liability. There's ways to do it, and we already did it last year, and you could do it too. So stay tuned for that. I want to get into the AMT because this is a sneaky one.
Yes.
Because a lot of people may invest in oil and gas, and then they get hit with AMT. And what
Especially
is AMT?
If it's a first couple oil and gas operations, that's where it's more likely to hit them.
Yes. So what AMT is, it's alternative minimum tax. And the IRS imposed this because a lot of wealthy people were aggressively reducing their federal taxes. So what they created basically a mirror tax system. It's running behind the scenes and you don't even know it, but it's Form 6251 on every tax return you file, typically every tax return.
Can I just do a soapbox for 1 minute here?
If you want.
I do.
Who might have stopped you?
I'm going to do it, man.
Okay.
I insist. AMT came out in like the 60s, I think the late 60s or early 70s. When it came out, it was said that the reason we're going to start doing AMT, and then it really came out in the 80s, we're doing this to charge just the richest of the rich to make sure they pay their fair share. Well, at that time, the levels of AMT, when it actually applied or hit people, they were pretty darn rich. But they didn't adjust that for inflation. Now, you have people, up until the Tax Cut and Jobs Act of 2017, you had people making $120,000 a year getting hit with AMT. Unbelievable.
Stupid.
I don't like the unfairness parts of the tax code. Thankfully, that's being rectified, and it's not all only. It gives you a little more breathing room. Now, if you're making a few $100,000, it might hit you in this specific area. But sorry, had to get the soapbox. Go for it. Go.
Okay, so what AMT is, it's that mirrored system. You have your income tax, and then you have a minimum tax you have to pay. So there's some deductions you take as on your federal tax return that get added to your alternative minimum tax income. Gets added back. That they're going to say, okay, you got too aggressive over here, so we're going to add some of that deduction back over here. IDC is a preference. It's called a preference item on your AMT. So you could get a huge tax deduction on your federal taxes, but when you go to calculate your minimum tax of what you have to pay, then at that point it could be added back. There are some large deductions that aren't subject to AMT. You can get your tax liability legally to zero, but IDC is one of those tax preference items. If your IDC exceeds up to 65% of your income, so if you make $100,000 and your IDC is $65,000, then that is your baseline of what you can deduct. You can't deduct over 65% of your income. Otherwise, that's going to be a preference item, and that excess gets added to your income.
There are also thresholds based solely on your income from oil and gas activities. So if this is your first investment in oil and gas and the other thresholds hit you, then they say, well, how much money did you make from oil and gas? Generally speaking, first-year investments in oil and gas make no oil and gas income. That's the purpose. That was the plan. It takes them months to get that well drilled. It takes them months to start pumping oil, and then it takes them months to start getting paid for the oil that they're already selling. 9-month delay is pretty common in this field. So in that first year, if this is your first oil and gas investment, you're going to be limited because you have no income or less income from your oil and gas. As you grow your oil and gas portfolio, you're going to have oil and gas income, and then it becomes less of an AMT issue.
Yep. And not all is lost. There is actually some help on this side of the AMT. Let's say you pay $10,000 of AMT. You saved maybe 20 on your taxes, but then 10 got added back. So you still are good. You're better off, but you had to pay that extra 10. That AMT you paid is a temporary difference. So that carries forward as a tax credit for you. So now that AMT that you paid in, let's say 2025, you paid AMT, you should on your tax return, if prepared correctly, is going to have an AMT tax credit carry forward. So now the government's going to allow you to take a credit of $10,000 on your future tax return against your normal income tax. So it's a timing issue. You're going to pay some tax today, some AMT, but then you're going to reduce your tax liability in the future. So not all is lost with AMT, but just be careful if you're tax planning and you're saying, oh, I'm going to get this big, beautiful deduction, which you are, but just be careful of this sneak attack that the government could perform on you on the AMT, because not many people think about AMT.
No. I hate to think about AMTs. Even though it's my job, I hate thinking about AMT because it's just not fair.
It isn't fair.
We pay our fair share. So after we get past the AMT, the IDCs, you got to have a working interest. You got to have general partner interest in the year that you're getting those IDCs to be able to deduct it against your W-2. The first time I invested in oil and gas was back in 2001, I believe. I was looking at it. I was terrified about this general partner liability. Let's talk about that a little bit. I hired 2 different attorneys to give me an opinion. Would it be dangerous? How much true liability am I assuming? I mean, there's real liability, but what's the probability of this happening? My first attorney went and searched. He said, if you're a passive investor in a general partnership, he could not find one time where someone was sued as a passive investor in a general partnership. I talked to Kevin about this. I was like, hey, so they say that, but I'm still scared. You told me I was an idiot, I think. You're like, Mike, come on, be reasonable. But I tend to like to be more overinsured, right? I like insurance. I want to sleep well at night. I worry about the crap that I don't know is going to happen out in the future. That's why I have so much insurance. Kevin said, don't worry about it. I was still worried about it. So then I had another attorney, told me the exact same thing. And so then I called an insurance broker and I asked him, hey, I'm about to make this investment. Can you get me a policy that will protect me, my general partner liability for this year or year and a half I'm going to be a GP in this oil and gas? It took him a while to find a policy.
He had to shop a long time.
He did have to shop a long time. About 6 months later, he's like, I found a policy. We can do it. That was in 2021. Now, It's not like that. That same broker, we had one of our clients go to him because I said, hey, he found me, he wanted insurance just like I did. He wanted insurance in oil and gas as a passive investor. He went and found my insurance broker. My insurance broker spent another 6 months looking and came back and said, I can't find the
They're
policies
not touching
anymore.
oil and gas.
They
and
don't
carriers.
want to touch oil and gas. I don't know why. It's dumb. But
I don't know.
No one's ever getting sued for a partnership, according to lawyers. So why does insurance not do it?
It is a risky industry. I can see their point. I mean, there's drill heavy equipment, and then I mean, I don't know. Maybe the news
and
cycles
environmental law, and you've got all these class action state lawsuits suing all the big oil companies for emitting carbon into the atmosphere. I just breathed. I emitted some carbon. Sorry, guys.
Yeah.
Don't sue me, California, please. So I don't know why. It's just something that they won't touch now. I still don't like that liability. It's almost impossible to find. But Kevin, you and I, we wanted to invest in some oil and gas last year. We did not want to put all our eggs in one basket. Most of these good syndications, we are accredited investors, but most of these good syndications, they have like a 250 minimum buy-in. And that was actually more than you or I could invest in 1 year. And we didn't want to put all our eggs. We believe in, talk to me about diversification. You're a huge believer.
Yeah, I'm huge. Yeah, my investment theology is so you're overinsured, I'm underinsured, over diversified. So I guess I'm conservative in some areas too. But in oil and gas, what happens is, like Mike said, you have minimums to get into these deals. So if you're like, hey, I make $300,000 a year, I'm accredited investor, I want to just dip my toes into this oil and gas stuff and start reducing my W-2 income. You could go to an operator and they say, okay, the minimum to even get in is $250,000 because they're raising maybe $100 million. They don't want a bunch of small investors. They just want some bigger investors to reach their target so they can actually start drilling. So they don't want a bunch of small investors, even though $50,000 I don't even view as small. But when you're talking $200 million, it is. You need a lot of investors to reach that goal, or you can set a minimum. So now for you to invest into this deal that you like, you need $250,000, which you may or may not have. Then if you do have it, all your eggs are in this operator. Hopefully the well didn't come up dry. Hopefully all the reports are coming back that, we are hitting oil and you're going to get a return on that, because the tax break is good on $250,000, but it hurts later in the year if there's nothing coming back.
Don't let your tax tail wag your investment dog.
It's an investment, right? So now, what we've developed, Revo ourselves, we have developed our own interest fund, working interest fund. And what this is we have operators in our fund. So we take the $250,000 minimum operator, we put them in our fund. We take another $50,000, put them in our fund. We take all these operators with different minimums and we put them all into our fund, meaning that, and they all have different kind of drilling theologies, different locations, geographical locations in the country.
Diversified as I think you can get with one investment in oil and gas.
Yeah, we have different people in Texas, Louisiana, Pennsylvania. So they're in different geographical locations, because guess what? If your operator's in Texas and we saw a odd wet summer, they can't drill. It's too wet. Mud will dry you, or not dry you up. It'll stop production. So we take those operators, we put them in our fund. We set our minimum at $50,000. So you can invest in our fund at $50,000 minimum. Then we take your 50 and dice it into fourths or fifths, depending on how many operators we have. And we put your investment into these operators, and you're hitting these operators that have a minimum of 250. You're hitting that minimum there because you're pooling your money with other investors. I'm taking your $50,000 investment and dicing it up into 10,000s, but then I have other investors doing the same, and now I'm taking your 10,000 and hitting the minimum here. We're diversifying your investment.
So we had a fund investing in other funds, ergo the term fund of funds. That's what fund of fund means.
Fund of funds.
A fund of funds. And we did that. And there's other people that do that sometimes. It's hard to find, but there are others out there. But then we saw that general partner liability.
They're not better than us, I tell you that. There are people that do this fund of funds, but the way that we do it, we have two huge advantages in our fund. The first one, we know what we're doing on the tax side. We operate and breathe tax. So when we get these operators working, you're going to get the best tax deduction in our fund, because we're going to report on a well-by-well basis. We're not going to generalize the deduction. We're not going to get into the specifics, but it's
a big difference.
It's a big difference.
And most funds, big funds, don't even do that. We
try to coach our oil and gas operators. You need to do a well-by-well basis calculation for depletion. Yeah, and they say, it's too much. We're just going to pool it. They might have 50 wells or 20 wells withdrawals. It is a headache to do it, but it's going to be profitable. We can get into that into a different episode.
We should do an episode.
So that's number one, is you're going to get the biggest tax deduction squeeze out of these investments as possible. The second one, which lands right where kind of at the beginning when we were saying this liability, if it might feel like a weight.
Scares me.
It might feel like this weight. We're going to take that weight off of you because we have insurance in our fund that we found a carrier that's going to insure our general partner investors from the personal liability that does not scrub away the tax loss. You are active general partner for tax purposes, but you have insurance. So if ever there is a claim, you're going to be insured. And I'll tell you, good luck if you are personally investing like you did, looking personally to find an insurance carrier. You're not going to find it. And if you do, the premium is going to be 30% of what your investment was. If you invest $100,000,
our premium was still pretty high, but we took a partner vote. And,
we did.
And our partners, I think there was 2 partners that did not want to do it. And I think you were one of them.
I was one of them. I got outvoted.
The rest of the partners did it. But then, man, I sleep so much better at night. And I know a lot of our investors do. It does take some of the ROI away going into insurance, those greedy insurance people making some money. But we are qualifying for the tax deduction with general partner liability, but we have a general partner insurance policy in oil and gas.
Covers all of us and the investors.
It does. All of us. That is cool. I mean, there's caps on the insurance, like a certain amount. So there's it's not, there's always some liability risk, and there has to be to get this deduction, but we mitigated it a lot. Oil and gas. So one other thing before we can close this out, Kevin, and we could talk about this for a long time. We should do a series on this. But one other thing we haven't mentioned, you get that big IDC deduction. That's beautiful. But as you start getting cash flow, and let's say you're in some wells that are producing for 20 years, you get 20 years of cash flow. When you get those dollars back in distributions, there's a tax benefit to them too.
You only get taxed on 85% of your income, and that's called depletion, which we'll do a totally new episode on depletion. But yeah, every dollar that you get as a return from an oil and gas operation, not only did you get the big bump of IDC, but every dollar you make is only taxed at 85% of that dollar. Not 85% tax rate. I'm saying your dollar, you receive a dollar, you're getting taxed on 85 cents of that dollar.
So you get
beautiful.
70, 80 with bonus depreciation this year, maybe 90% immediate deduction write-off against your active income. And then for as long as your wells are paying out, you're only paying tax on 85% of the income. God, I love oil and gas.
It's great. And this whole push, like everything that's happening with Iran, not to get into politics, but politics play a big role in this industry.
Yes,
so you can't avoid it. So everything that's going on with Iran, if they, I think right now with the trading routes are good, but if somehow the trading routes shut down, I mean, just look at the news over there. It's chaos in the Middle East, and a lot of oil comes from there. There's massive incentives to us to be energy dependent, like you led off with. It's so important for our country that we invest in this industry, no matter if it's a Republican or Democrat in office. It doesn't change the facts that, we need to be partners with other countries in this world. We don't operate as a silo, nor should we. But we shouldn't be so reliant on the other countries for our energy. There's thousands of years of oil, probably just in Texas and Alaska alone, that we can go harvest. It's out there. That's why the incentives are in the tax code, is because.
But wait, I heard in the 70s we were going to be out of oil by the year 2000. Then I heard in the 90s we're going to be out of oil by the year 2020.
I wasn't alive in the 70s.
Yeah, you rub that in, young guy.
I'll take your word on it.
There's oil. They're going to find oil. You can be green. I am green. I like electric vehicles. I have solar panels over almost every square inch of my roof. But the fact is, we can't go fully green immediately. Even if we put a Manhattan Project level incentive and funding into going green, it's going to take decades and decades. Oil and gas is needed. Might as well make some profit on it. Might as well let the IRS subsidize your investment into it to make that profit. As I say, it's a gold mine, oil and gas. Consider it. And there's ways to mitigate the liability if that's what keeps you scared, like it did me.
Yeah. And to think about the future. Yeah. If we go EV, if we go energy dependent on electric vehicles or solar or whatever it is, who makes solar batteries How do you transport
China
goods?
does it, and they do it with diesel that they buy from somewhere because they don't have it. So they get it imported from Russia. They need more of it.
So,
we can send it there.
Yes. So even if we go completely green, which I would expect with this big, beautiful bill that's passing, the EV incentives are actually going down. We're actually pushing more Motor City. Just let's get some gas guzzling stuff on the road. Take it or leave it.
Like it or not, that's where
what
the
it is.
money's going to be, and that's where the tax deduction is.
So that's 101, IDC 101. Please like, comment, subscribe to this video. Go to revoinvestor.com. Revoinvestor.com is that diversified fund that Mike and I have for working interest. Just if you're interested in learning more about our fund, it is the best product I have seen in the oil and gas industry, bar none. And I have been doing this for 20 years. And I'm not biased. Well, kind of. This is our fund. But we created this with the love of tax, the love of diversification and safety, but also ROI. So go check us out there. If you're interested, fill out a form and we'll be in touch with our next offering into 2025.